Index funds have become a popular choice among investors, seeking a straightforward and cost-effective way to diversify their portfolios. These funds track specific market indices, offering a way to invest in a broad market segment with minimal management fees. Let's explore the details of index funds, their benefits, strategies for investing, and important considerations. Understanding index funds. Index funds are mutual funds or exchange-traded funds, ETFs, designed to replicate the performance of a specific market index, such as the S&P 500, the Dow Jones Industrial Average, or the Nasdaq Composite. Instead of actively selecting individual securities, index funds aim to mirror the performance of an entire index by holding the same securities in the same proportions. Benefits of index funds. Diversification. By investing in an index fund, you gain exposure to a broad range of securities within the index. For example, an S&P 500 index fund provides exposure to 500 of the largest US companies, reducing the risk associated with investing in a single stock. Low costs. Index funds typically have lower management fees compared to actively managed funds. Since they don't require extensive research or active management, the cost savings are passed on to investors. This can result in higher net returns over the long term. Simplicity. Investing in index funds is straightforward, and requires minimal effort. You don't need to pick individual stocks or time the market. Instead, you can invest in a fund that tracks a specific index and automatically benefits from its performance. Transparency. Index funds are transparent in their holdings, as they aim to replicate the index's performance. You can easily see the underlying securities and their weights within the fund, providing clarity on what you're investing in. Consistent performance. Since index funds aim to match the performance of an index rather than beat it, they provide consistent returns in line with the market's performance. This can be advantageous for investors who seek stability and predictability. Strategies for investing in index funds. Choose the right index. Select an index fund that aligns with your investment goals and risk tolerance. Major indices like the S&P 500 or the Nasdaq may suit investors looking for broad market exposure, while sector-specific indices can provide targeted investment opportunities. Regular contributions. Implement a systematic investment approach by making regular contributions to your index fund. This strategy, known as dollar cost averaging, helps mitigate the impact of market volatility and ensures consistent investing over time. Long-term focus. Index funds are well suited for long-term investors. The goal is to benefit from the overall growth of the market, so maintaining a long-term perspective can help you ride out short-term fluctuations and achieve compound growth. Diversify across index funds. To further diversify your portfolio, consider investing in multiple index funds that track different indices or asset classes. For example, you might combine an S&P 500 index fund with an international index fund or a bond index fund. Rebalance periodically. Over time, the performance of different asset classes within your portfolio may shift. Periodically rebalance your index fund investments to ensure they remain aligned with your target asset allocation and investment objectives. Common index funds. S&P 500 index funds. These funds track the performance of the 500 largest publicly traded companies in the US. The S&P 500 index is often used as a benchmark for overall market performance and provides exposure to a broad range of industries. Total market index funds. These funds aim to capture the performance of the entire US stock market, including small, mid, and large cap stocks. Total market index funds offer comprehensive exposure to the equity market. International index funds. These funds track indices representing international markets, such as the MSCI EAFE index, which includes developed markets outside of North America. International index funds provide diversification beyond US borders. Bond index funds. Bond index funds track indices of fixed income securities, such as the Bloomberg Barclays US Aggregate Bond Index. These funds offer exposure to a broad range of bonds, including government, corporate, and municipal bonds. Considerations and risks. Market risk. Index funds are subject to market risk, which means their performance is directly linked to the performance of the underlying index. If the index declines, the value of the index fund will also decrease. Limited upside potential. Since index funds aim to match the performance of the index, they may not provide the same level of returns as actively managed funds that can potentially outperform the market. Tracking error. While index funds strive to replicate the performance of the index, small discrepancies can occur due to management fees, trading costs, or imperfect replication. Tracking error refers to the difference between the fund's performance and the index's performance. Lack of flexibility. Index funds do not allow for active management or selective security picking. If the underlying index includes poor performing securities, they will still be included in the fund's holdings. How to choose an index fund. Expense ratio. Look for index funds with low expense ratios, as lower costs can enhance long-term returns. Compare expense ratios among similar index funds to find the most cost-effective option. Fund size and liquidity. Consider the fund's size and liquidity, as larger and more liquid funds typically offer better trading conditions and lower bid-ask spreads. Fund provider. Choose index funds from reputable fund providers with a strong track record and reliable performance. Research the provider's history, reputation, and customer service. Investment minimums. Check the minimum investment requirements for the index fund. Some funds may have minimum investment amounts, while others may allow for smaller investments. Real-life examples. Vanguard 500 Index Fund, FIAX, one of the most well-known index funds, tracking the S&P 500 index. It offers broad market exposure, with a low expense ratio. Fidelity Total Market Index Fund, STAX, provides exposure to the entire US stock market, including small, mid, and large cap stocks. It offers comprehensive market coverage. iShares MSCI Emerging Markets ETF, EM, tracks the performance of emerging market indices, providing exposure to developing economies. Schwab US Aggregate Bond Index Fund, SWAG, tracks a broad index of US investment-grade bonds, offering income and stability. Index funds are a valuable tool for investors seeking diversification, low costs, and simplicity. By understanding the benefits, strategies, and considerations associated with index funds, you can make informed investment decisions and build a well-rounded portfolio that aligns with your financial goals. The benefits of investing in index funds. Index funds have become increasingly popular among investors due to their simplicity, cost-effectiveness, and potential for long-term growth. Let's delve into the key benefits of investing in index funds and how they can fit into your investment strategy. Cost-effectiveness. One of the primary advantages of index funds is their low cost. Unlike actively managed funds that require a team of analysts and managers to make investment decisions, index funds passively track a specific market index, such as the S&P 500. This passive management results in significantly lower fees, including lower expense ratios and fewer trading costs. By investing in index funds, you can keep more of your returns rather than paying high management fees. Diversification index funds provide broad market exposure, allowing you to diversify your investments across a wide range of companies within a specific index. For example, an S&P 500 index fund includes shares from the 500 largest publicly traded companies in the US. This diversification helps reduce risk by spreading your investment across multiple sectors and companies, minimizing the impact of poor performance from any single stock. Simplicity investing in index funds is straightforward and requires minimal effort compared to picking individual stocks or managing a portfolio of actively managed funds. With index funds, you can invest in a broad market index with a single purchase, making it easier to build and maintain a diversified portfolio. This simplicity is particularly appealing to beginner investors or those who prefer a hands-off approach to investing. Consistency and performance index funds aim to replicate the performance of a specific market index, which historically has provided steady and reliable returns over the long term. While they may not outperform the market, they also avoid the risks associated with trying to beat the market through active management. By investing in index funds, you align your portfolio with the overall market performance, benefiting from its long-term growth potential. Transparency index funds offer transparency in terms of holdings and performance. Since index funds track a specific index, you can easily see which stocks are included in the fund and how the fund is performing relative to the index. This transparency allows you to understand exactly what you're investing in and how it fits into your overall investment strategy. Tax efficiency index funds are generally tax efficient due to their low turnover rates. Because index funds follow a set index and do not engage in frequent buying and selling of stocks, they generate fewer capital gains distributions. This can result in lower tax liabilities compared to actively managed funds that frequently trade stocks and may incur higher capital gains taxes. How to choose the right index fund to determine your investment goals. Consider your financial objectives, risk tolerance, and time horizon when selecting an index fund. For long-term growth, you might choose a broad market index fund, while for more targeted exposure, you might select a sector-specific index fund. Compare expense ratios. Evaluate the expense ratios of different index funds to ensure you're getting the best value. Lower expense ratios can significantly impact your long-term returns, so choose funds with competitive fees. Examine tracking error. Tracking error measures how closely an index fund's performance matches the performance of its benchmark index. A lower tracking error indicates that the fund is closely tracking the index, which is desirable for index investors. Review fund holdings. Check the fund's holdings to ensure it aligns with your investment strategy. For example, if you're investing in an S&P 500 index fund, verify that it includes the 500 largest companies in the US. Consider fund size and liquidity. Larger index funds generally have better liquidity and lower bid-ask spreads. This can be important for minimizing trading costs and ensuring ease of buying and selling shares. Types of index funds. Broad market index funds. These funds track major market indices, such as the S&P 500, the Dow Jones Industrial Average, or the Total Stock Market Index. They provide exposure to a wide range of companies and are ideal for investors seeking overall market performance. Sector-specific index funds. These funds focus on specific sectors of the economy, such as technology, healthcare, or finance. Sector-specific index funds allow you to target particular industries and can be useful for diversifying within specific market segments. International index funds. These funds track international or global indices, providing exposure to markets outside the US. They can help diversify your portfolio globally and reduce exposure to domestic market risks. Bond index funds. These funds track bond indices and provide exposure to various types of bonds, such as government, corporate, or municipal bonds. Bond index funds offer income and lower volatility compared to stock index funds. Socially responsible index funds. These funds track indices based on social or environmental criteria, such as sustainability or ethical investing. They allow you to invest in line with your values while achieving market-based returns. Common misconceptions about index funds. Index funds aren't for growth. Some investors believe index funds are only suitable for conservative or income-oriented strategies. However, index funds can provide significant long-term growth potential, especially when investing in broad market indices or growth-oriented sectors. Index funds guarantee market returns. While index funds aim to replicate the performance of an index, they do not guarantee positive returns. Market downturns can impact index funds, but their long-term performance generally aligns with the market's overall trajectory. Index funds are too simple to be effective. The simplicity of index funds is a strength, not a weakness. Their effectiveness lies in their ability to provide broad market exposure at a low cost, making them a powerful tool for achieving long-term investment goals. Incorporating index funds into your investment strategy. Use index funds for core holdings. Consider using index funds as the foundation of your investment portfolio. They provide broad market exposure and stability, allowing you to build a diversified base for your investments. Combine with other investments. While index funds are a valuable tool, consider combining them with other investments to achieve specific objectives. For example, you might add sector-specific funds, bonds, or individual stocks to complement your index fund holdings. Rebalance regularly. Periodically review and rebalance your portfolio to ensure it remains aligned with your investment goals and risk tolerance. Index funds can be a key component of a well-balanced and diversified portfolio. Index funds offer a cost-effective, diversified, and straightforward approach to investing. By understanding their benefits and choosing the right index funds for your investment goals, you can build a solid foundation for long-term financial success. Their simplicity and effectiveness make them an essential part of a comprehensive investment strategy. How to select the right index fund for your portfolio. When it comes to investing in index funds, choosing the right one can make a significant difference in your overall returns. Here's how to go about it. Identify your investment goals before diving into specific funds. Clearly define your investment goals. Are you looking for long-term growth, steady income, or a mix of both? Understanding your objectives will help you select an index fund that aligns with your financial targets. For instance, if you're aiming for long-term growth, you might prefer funds that track broader markets like the S&P 500 or total market indices. Assess the index tracked by the fund. Each index fund tracks a different market index, which determines the composition of the fund. Research the index that the fund follows. Popular indices include S&P 500, represents 500 of the largest companies in the US, and is a good indicator of overall market performance. NASDAQ 100 focuses on 100 of the largest non-financial companies listed on the NASDAQ stock exchange, often tech-heavy. Russell 2000 tracks 2,000 small-cap companies, providing exposure to smaller, emerging businesses. Selecting an index fund that tracks an index aligned with your investment strategy is crucial. For example, if you're bullish on technology, a fund tracking the NASDAQ 100 might be suitable. Evaluate the fund's expense ratio. The expense ratio is a key factor in choosing an index fund. This percentage reflects the annual fees charged by the fund, including administrative and management costs. Lower expense ratios mean that a smaller portion of your returns is eaten up by fees. Look for funds with low expense ratios, as these tend to provide better net returns over time. Index funds are generally known for their low fees compared to actively managed funds. Consider the fund's tracking error. Tracking error measures how closely the fund's performance matches the performance of its index. A low tracking error means the fund is closely tracking its index, while a high tracking error indicates more deviation. For most investors, a lower tracking error is preferable, as it suggests the fund is accurately mirroring the index's performance. Review the fund's historical performance. While past performance doesn't guarantee future results, reviewing how the fund has performed historically can provide insights into its reliability. Look at how the fund has tracked its index over various time frames: 1 year, 5 years, and 10 years. Consistent performance close to the index's returns is a good sign. Check the fund's size and liquidity. Larger funds generally offer better liquidity, meaning you can buy or sell shares without significantly affecting the price. A fund with higher liquidity can be advantageous, especially if you plan to make large transactions. Check the fund's average daily trading volume and total assets to gauge its size and liquidity. Understand the fund's tax efficiency. Index funds are generally tax efficient because they have lower turnover compared to actively managed funds. However, some funds are more tax efficient than others. Look for funds that have a history of low capital gains distributions. This can help you minimize tax liabilities, which is especially important if you're investing in a taxable account. Compare similar funds. Once you've narrowed down your options, compare similar funds. This might involve comparing funds that track the same index but are offered by different fund providers. Look at their expense ratios, tracking errors, historical performances, and other key factors to make an informed decision. Align with your overall investment strategy. Finally, ensure that the index fund you choose fits well with your overall investment strategy and portfolio. It should complement your other investments and help you achieve your financial goals. Consider how it fits into your asset allocation and whether it helps diversify your portfolio. By following these guidelines, you can select an index fund that aligns with your financial objectives, minimizes costs, and maximizes potential returns. Don't forget to subscribe in the channel and like the video for more contents.